today's part with the following interruption for a public service announcement.
Welcome to the Investing in Intelligence show, where we talk about artificial intelligence company stocks, trading, and market crashes. I'm James, here with my co-host Kai, and today we'll be talking about market crashes. I want to remind you that the opinions expressed on this show are just that, opinions. They should not be taken as specific advice to invest in a particular way or disinvest or flee in a particular way. So Kai, where we stand in this particular moment, S&P is down 6.5% from its high. The Nasdaq is over 10% down from its high, meaning we are in official correction territory on the Nasdaq. Just to give some context, and we'll be giving a lot of context on this emergency flee for the hills episode, the S&P has dropped more than 5%, 239 times since its inception. The median decline is 8.25%. Once it goes over 5%, on average, it goes 11.8%, but the median is 8.25%. So generally, when you have a drop of more than 5% in the S&P, you can expect a drop of 8.25 to 11.8%. So 8.3 to 12% is the general drop that occurs in the S&P once it goes more than 5%. And we're now down 6.5%. Most people are saying we're going to go further. I have a lot of takes on this, but we're also facing a possible attack from Iran on Israel, which could upset oil supplies, lead to higher inflation. We know that we have issues with the labor market, a lot of things scaring a lot of people, and a lot of things are going down, including today, recording this Saturday, August 3rd. We have crypto crashing. Bitcoin has gone from a recent high of 69,800 down to 60,100 as of the time of this recording. Initial thoughts, Kai?
I have multiple. I really am interested to get your thoughts. I'd make a few comments, and then I'll have some thoughts and some questions for you. One I would say is, this is something you have been saying. I mean, we've been focusing a lot on positivity in regards to AI. We have both been saying that we are in the build out phase of AI, cloud networking build out. However, we've both talked about, I know I've talked about in particular, watching the narrative in regards to earnings and numbers and making sure that there's an end game in regards to AI, that basically this AI build out becomes profitable. That being said, that's number one. The other one is, you, James, have said very subtly over the last 2 or 3 episodes or even more, that the jobs report has been concerning. And I think this has been going on over the last 2 to 3 months, where the jobs report is concerning. And this most recent one, I think the statistic, and you can correct me if I'm wrong, is somewhere around 20% increase in basically unemployment. And so we had really a Katy Perry song of a weekend. And we also had a little bit of scone. Did you have some scones with your Bloody Mary on Friday? I mean, did you enjoy the bloodbath, James? I mean, and so I really wanted to see your comments on that, because that has been something you've been echoing, where the world has been basically patting themselves on the back. You've been saying, hey, watch jobs, watch jobs, watch jobs. And so we had a perfect storm of events in that the numbers were good. I mean, I liked Amazon's numbers. I liked Meta's numbers. I liked Apple's numbers. Did they blow anybody out of the water? And do we have an end product of AI yet? The answer to that is absolutely no. Coupled with Intel. Oh my gosh, we haven't covered Intel in an episode. Maybe we should. I think we should cover Intel in the future. So we'll check out our future episodes. We'll talk about Intel. But what do you have to say, James, in regards to, let me just get your take on the jobs and kind of highlighting that over what you and I have been saying over the last 2 to 3 episodes. And I also want to see what you have to think about what I just said in regards to the end game of AI. You and I both believe that this will show profitability, large growth, and bring about basically, I don't want to use the term revolution, but a revolution in how we deal with things just in everyday life. But what do you think about, just in general, your prediction 3 or 4 times the last episode in jobs? What would you have to say about that?
So unfortunately, you have to forget about the end game of AI right now. You have to forget about your specific stocks. You have to forget about Amazon. Only thing you can think about right now, when the VIX is up over 50% in a day, when you have Fed members who probably already regret not lowering interest rates 3 days ago. Unfortunately, in this particular moment, you have to really go back to brass tacks. You have to figure out, are we going into a recession or not? That's what you need to understand. Is this a pullback? Is this a drawdown? Is this a correction? Or is this an impending recession? That's your first priority. So we'll talk about that first, and then we can get to some specific stocks. And I have pulled up a little analysis on the pullbacks in specific AI stocks, and we can comment also on we can comment on the trajectory of AI. But yeah, let's go to
Well,
jobs.
yeah, so talk to me about that. Just for a basic listener, you've been saying this over the last 3 or 4 episodes. So basically, the last couple months, I think you've been saying this, and you've been talking about this with me in particular, sending messages back and forth. So why does that matter? And basically, what happened? Just for our basic listener, they're like, "What in the world? It's not really changed. Life hasn't changed for me. Why did the stock market drop to 1.5% today, 2%? The Nasdaq, S&P. Why? Just
Yeah.
why?"
And on Thursday, I sent you a message and I said, hey, watch out. Tomorrow is yet another employment jobs related report. It could be a very bad omen. And then it was. Now, we were obviously ecstatic on Wednesday because we had that big bump up. It was hopeful things were looking good because the Fed was talking about lowering rates at the next meeting. But then we had 2 consecutive days of really concerning reports. So, what I'm going to do, I'm going to do 2 things. I'm going to give you in 1 minute all the 4 things you need to watch to know whether going into a recession. And then in another minute, 60 seconds, I'm going to give you where all of those things stand right now. So I'm going to start. I'm going to give you all, I'm going to give you everything you need to look at to know whether or not we're going into a recession and whether the stock market is about to crash in 60 seconds. Firstly, initial jobless claims. When initial jobless claims go above 250,000, that's a recession signal. Secondly, total monthly non-farm jobs added. When that number is below 125,000, that's bad. When it's below 100,000, it's even scarier. That's a recession signal. The ISM PMI, which is a domestic manufacturing index, when it goes below 400, so when it goes below 45, that warns of a recession. When it goes below 42.5, that indicates an economic contraction. And lastly, GDP. When GDP is sharply declining or even a gradual decline over multiple quarters, that's a recession signal. So we have 4 things here that tell you we're going into a recession. So let's look at where we stand on those 4 things right
Well,
now.
let me give you credit. So you've been singing this tune to me. We haven't highlighted it on the show, but you have basically said this. But I will say you've been very bullish. So based on those 4 things, you've kind of thought. I mean, I've said, "Hey, James, I don't know, soft landing. We've been talking about this for a long time." You've thought soft landing for a long time, soft landing. So my question for you is, do you see a hard landing or a soft landing, or basically no landing? We're fine. We're just going to land smoothly.
All I see is data. Data changes every day, every week, every quarter, every year. So, like a good doctor, your patient changes every day. And you can look at the trend over the last week of your patient in the ICU. But if suddenly they're breathing rapidly, their blood pressure is dropping, you have to reevaluate that patient that moment, that hour. You can't say, oh, but they were doing great over the last week. All that matters in that moment where your patient is destabilizing is that moment. And that's where we are right now. We have to evaluate these things now and not worry about where they were over the last month, 6 months. We have to say, where are things going now and in the future? So starting with, let's take 1 minute and look at the 4 recession signals and where they stand right now. So we said initial jobless claims above 250,000 is concerning. Where do they stand right now? 249,000. The highest number in recent memory was back in June. It was 243,000. This is the highest number that we've had in months. We also said total monthly non-farm jobs added, if that's below 125,000, that's recession signal. Well, guess what? Right now it's below 125,000. It's at 114,000, lowest number that we've had in many months. And we're concerned it'll be revised lower, maybe even cut in half with the coming reports. Nextly, PMI manufacturing. We said if it's below 45, that warns of a recession, but even 45 to 50 is bad. Where do we stand right now? 46.8. That's down from the prior month. Lastly, GDP. If we have a sharp gradual decline in GDP, quarterly GDP, that's also a recession signal. Where do we stand right now? Well, pretty good, 2.8%. It was 1.4% the quarter before that. In other words, 3 of the 4 recession signals are in play. They are concerning, they're indicating a possible recession, but GDP is still good.
So
Now,
from a macro standpoint, what is your view overall? I mean, yes, you're looking at the patient. However, when you're a doctor, you gain a certain amount of experience by seeing different patterns. What's your just view? What's your overall take in regards to the big picture of things right now?
yeah, these 4 things are key. You got to look at these first. There's a lot of little things like, oh, did Visa report good numbers? Is consumer spending? What about credit card balances? All that. There's all these other things, but you don't really want to worry too much about those things because these 4 things really aggregate what you need to know, to be honest. So I would say that here's my general take on the issue. These labor numbers, unfortunately, can't be trusted 100% because we know 2 things. We know that immigration has artificially elevated the number of payroll increase, so non-farm payroll increases. We've had that artificially high because of massive immigration that's been legalized by the federal government, and jobless claims have probably been lower because of that too. Now, I'll also mention government hiring because of the federal government stimulus programs, the bloating of the bureaucracy, the federal agencies. We've had higher government hiring than we've had in recent history. So basically the job numbers have been artificially inflated. Now, Biden did do some kind of small curtail on the border a month or so ago for political reasons. And that may have actually affected some of these job numbers and made them start to go in the direction that the federal government doesn't want, that doesn't look good. So we may be having, I want to call it a political correction in these job numbers that's looking like an economic correction, but in reality, maybe this is how it would have been if we were just looking at these numbers accurately anyways. So I would say for the job numbers, maybe we really are just like scraping the cream off the top and looking at what was really there all along. That's a very real possibility. The PMI is concerning. You don't want to see PMI coming down, and then GDP is good. So overall, no, this isn't a run for the hills moment. This is a watch very carefully for the next 6 weeks moment. We've got 45 or so days until the next Fed meeting where they're guaranteed to lower rates. I said guaranteed to lower rates. They were going to lower 25 basis points was the market's prediction. Now there's an 80% chance they're going to lower 50 basis points. But if the data gets worse, I don't want to say 75 basis points, but I want to say 50 guaranteed. And then a lot of people think 50, 25, 25. So if the data gets worse over the next 6 weeks, and we're going to get multiple of these reports again over the next 6 weeks before the next meeting, then we're expecting multiple rate cuts this year. 50, 25, 25. Rates are coming down.
Well, okay. So, in instances like these, let me make a few points, if you don't mind. I agree with everything you said. In instances like this, I do think it's human nature sometimes to overreact. I am not saying the reaction wasn't warranted. I'm saying it could have been a slight overreaction in that we're in this unknown period. Okay. And so sometimes people start to think the worst. The jobs report numbers did not look good. The Fed needs to make a move, I think, and probably will. However, we don't know what's going to happen. Let me put some things in context. In the 1930s, stock market one-day drop. I mean, you're talking 25%, 1990s 8%, 1980s 10%. I mean, this is a 1.5% drop to 2.5% drop. In the overall context of things, all we know is basically we're in correction territory. The Nasdaq was not going to give an APY of 80 to 90% or 100% in a year. What goes up must pull back. I do not take this for me saying that we're not headed into a recession. That's not the point I'm making. The point I'm making is exactly what you said. Let's just look at the numbers, look at the facts, know where we're at, and what potentially may happen, and plan for all scenarios. That being said, my overall kind of macro picture of things is that for the last 8 years, we have spent more money than in the history of humankind, beginning through COVID and continuing with stimulus packages. When you have the same amount of goods and a lot of extra money, that is going to lead to inflation. We artificially created a recession because we overreacted to COVID. We artificially created a recession. The economy was good. COVID put us basically in an artificial recession because people weren't working. Okay. So here we are now. And I truly think we would have been in a recession. This is my particular view. We would have created a recession for ourselves from COVID if it had not been for AI build out. Big companies are spending big amount of cash because they have cash on the build out phase of AI. And what we've really been focusing on, the companies that are showing really good numbers, really good revenue growth, basically the thing that's been dragging the market along has been AI build out. Okay. We would not be there if it wouldn't be for Apple and Microsoft and Google and companies that have a lot of money to basically be buying GPUs, which lead to companies that make these GPUs and chips to increase their revenue growth. Okay. That's where we're at. That being said, through this whole process, we've really sort of forgotten about, and this is why the overall political sense, when you basically poll the average American, they don't think the economy is good. And why? Because it's created very large consumer, the average consumer feels pressure, and eventually something's going to give. And so I think we're in that particular time where right now we kind of are seeing basically the consumer spending is the wallets are getting tight. McDonald's, companies like Starbucks, McDonald's, even Amazon on their last earnings report basically talked about, well, we have some competition in the discount online avenue in regards to selling certain things. They had a record Amazon Prime Day. Why? Because the consumers are out to basically save a buck because of the inflationary cost of groceries, gas, everything, you name it, is higher. Houses, everything has gone up. Okay. That's my overall take. And right now, I don't know which way things are going to head. But I do know this is what the only things I can guarantee you is we're in a correction. Number one, the jobs market report was concerning, and then number three, the Fed is going to have to move. I don't know whether it's a quarter. I don't know if it's half. I don't know if it's 75. I don't know which one it is, but the Fed's going to have to move. So let me get to AI. Let me get to my question on AI. So AI bubble or not, and do you still believe in the end game of AI, the narrative there, that basically AI will become profitable? Because I think that is the most concerning thing, because the market has been held up artificially by this build out. What happens if none of this makes any money? What is your take on that?
Yeah, I understand that concern. And I just want to highlight, before I get to that concern, I want to highlight one last time that everything goes down if we go into recession. So whether or not you believe in the AI build out, whether or not they're the best companies in the stock market, everything goes down if we go into a real recession. And you just mentioned that you're not sure exactly what's going to happen with that, but I tell you, you will be sure over the next 6 weeks. So unfortunately, while we wait over the next 6 weeks for this data to be flushed out, a lot of people are just going to sell. So I do think we have further downdrafts here, maybe slight recovery, downdraft, slight recovery, downdraft. But before I get to your AI question, which I am going to address in depth, I want to just say one last thing, and that is that the two things that have historically caused downturns, only two things, are interest rate spikes, which we just finished, and then accelerating unemployment rates. Those are the only two things that historically have consistently caused bear markets. Interest rate spikes, that's behind us, done with that. We're done with raising interest rates. Now, the other thing is threatening us, and that's accelerating unemployment rates. So those two things are the concerns. We're done with one, but the other one now is rearing its head. And a lot of people at the beginning of the year thought there was a 25% chance for recession, and now that's going higher. So we have to worry about that first and our specific stocks second, because the specific stock will always be affected by the recession more than it will be its own performance. So you see people now cycling into things like Clorox, because they think Clorox is going to perform better than NVIDIA.
There wasn't much that was left unaffected. Well, at the end of this episode, we're going to talk quickly about Pega. Pega was a company that I really want to ask James about, so stay tuned.
I don't think we're going to do. I don't think we'll get to Pega today. But let me address your overall question.
Even if in the next episode we're going to do Pega, but I want you to answer about the most of what we've been focusing on is the build out phase of II. There's a few companies where like, hey, let's continue to watch the earnings to see if this plays out, right? So what type of moves have you made? Just particularly, we both have made some moves. I have been preparing kind of for this. I've been preparing for a pullback. I don't know about a correction, but a pullback since basically beginning of July. What have you done? Tell everybody else kind of what you've done and over this last month, and I'll tell everybody what I've done.
Yeah, firstly, I sold at the peak. When everyone's saying, oh, it's over, everything is overextended, I did trim positions at the peak. And since then, I'll tell you in a moment what I've done. But overall, the tricky thing about this is that investors have to understand when you feel this pain. If you own stocks and you feel this pain, that's not the time to run and hide. I understand there are momentum sellers and momentum buyers. So Investor Business Daily, they'll tell you, hey, once we fall into this level, you probably should start, getting out, run, because it's going to fall further. Well, I actually take the opposite position. My opinion is that you should have been trimming at the highs, and now you should be ready to start adding back because these are the real opportunities to buy. So just to give you an idea of what I'm talking about here, I want to just show the indexes before I mention specific stocks. You can see here, I pulled up the Nasdaq, and you can see kind of where we stand on the 200-day. So you and I both kicking ourselves by not buying more last October. Well, last October, you see that the Nasdaq pulled all the way down past its 200-day line. I've got an EMA and an SMA on here. They're both the 200-day line. They're about the same roughly as they should be. And you can see that last October 23rd, it pulled way down past both, but it was approaching that level for some time. That was a time period when you should have been buying. Anyone who's hearing this should have been buying because look how far we've come up since then. Now, even during March and April, you see April, we approached the 200-day line, but didn't quite hit it. And now we're probably similar. When you come to the current day on this chart, we're at a similar territory. We're pretty much close to March, but not quite to where we were last October. So we're approaching the April low from earlier this year, close to the 200-day line, but not quite as bad as last October. A lot of people think we're going into that last October state of being. No one really thinks we're going into a huge bear market right now, but 6 weeks from now, we could be talking like that. So yeah, I mean, if we're going to the 200-day line, maybe it is time for you to sell a little bit and buy back when we're there. But my personal opinion, I like to start buying now. And let's talk about some ways that you can do that or that you can play that. And I'll mention first some specific stocks. So the other chart that I had on screen a second ago, unfortunately, I didn't have time to fill this spreadsheet out as much as I would have liked. But you've got some major stocks here. So I just put 4 in here: NVIDIA, Meta, Broadcom, and SMCI. So what you have here is 4 of the big AI leaders. And we have how far they've gone up over the last 6 months, how far they've come down from their peak, their 52-week high. And then we've got their PE ratios. Tell us, are they now at an attractive valuation? So for NVIDIA, it's gone up 55% over the last 6 months, but it's down 24% from its 52-week high. It's down 24% peak to trough. So looking forward on the projected earnings, for those who say, yeah, earnings will be okay over the next year and a half, currently has a 20 PE for that level of earnings. But currently has a 28 PE for that level of earnings. But if you really think NVIDIA is going to knock it out of the ballpark over the next year and a half, the PE is 20. So the midpoint between those two is 24. So we can fairly say for forward earnings, NVIDIA is valued around 24 right now, which is probably where it should be. Maybe a little bit low. Okay, for Meta, we can see that it only gained 6% over the last 6 months. And from its high, it's down almost 11%. So conservatively, we can say with the conservative estimates for its earning over the next year and a half, it's going to have a forward PE of 20. Okay, that's a pretty fair PE. But if you really think Meta is going to knock it out of the ballpark over the next year and a half, its optimistic PE is 17. I'd say it's undervalued there. Midpoint, maybe a 19 forward PE. For Broadcom, up 15% over the last 6 months, down 23% from its high. So forward conservative PE 24, optimistic forward PE if they really knock it out of the ballpark 19. So that's a midpoint of 22 PE. And my favorite, could not leave this one out. SMCI is now down. So we've got NVIDIA up 55%. SMCI is actually down over the last 6 months. And from peak to trough, it's pulled back 49%. Okay, so Forward PE conservatively would be 18, optimistically 16. That's a midpoint PE of 17. Keep in mind, this was like the darling of the AI build out, SMCI, and it's down 50%. So let me just ask you a question. When we start to think about making money from pullbacks, Kai, let me just ask you a question. SMCI was at 1200. Now it's at about 600. So if you bought SMCI at 1200, just answer my question directly, Kai. How much percentage have you lost? If you bought it at 1200 and now you're at
Oh,
600, you
you
bought
lost
one share at
half.
1200.
You've lost
50%,
half.
correct.
Yeah.
You've
So
lost 50%. But this is the more important question. Don't worry about your 50%. Let me ask you this. If SMCI goes back, if you buy another share of SMCI at 600 and it goes back to 1200, have you made 50%, Kai? You bought another share at 600 and it goes to 1200 again. Have you made 50%? Yes or no?
well, no, because you
No.
lost 50. Yeah.
No. Forget about your loss. Let's say you forget about your loss. Okay. So we know you lost 50, but now I'm asking you, you buy a new share at $600 and it goes to $1,200. Did you just profit
Well, you made
50%? How much did you
100%.
profit?
Well, you made
You profited
100%. But
100%. Okay.
well,
So
let
even
me.
though you lost 50% previously, if you buy now, you can profit 100% on that next share. So let's say you intelligently trimmed your positions as things were high. If you buy back now, you can make more than whatever you have lost. So I'm just trying to underscore the fact that the best investors sell high and buy low. And we don't do that very often because we're scared, we're feeling the pain, and we want to sell when things are going down. That's the wrong thing to do. You have to gradually add as things go down.
Well, so are you saying that, again, don't take any of this as investing advice? Are you saying you're buying SMCI? I'm asking you right now.
Well, to be honest, pretty much anyone can take what I just said as investment advice because it's the same investment advice in every single book, website, video, anything you've ever heard talked about. That's the investment advice. You sell high and buy low. If you get scared and you sell when
I'm
things are
saying, I'm asking
low, you're screwing
you. I'm
yourself.
asking you. Are
So
you, James? Are you putting $2,000 in SMCI right now?
I'm there. I'm almost there. I'm almost there. I'm
Okay.
waiting a little bit longer, but
So
I started.
yeah,
I
I think
started
that's
buying.
great
Yeah.
as far as like what you're saying is you don't want to panic. I think a lot of this is what was your general take on my response to the overall macro picture of things over the last 2 years? Number one. Number two, I think having a battle plan, basically to not panic. Anytime you go into something, have a battle plan. And I think as you were going into this month and basically looking at July, we were oversold on things. We've talked about different companies, and it's basically saying, look at the price point. Qualcomm, we both like the price of. So on the after the pullback. So here's one of the things I would say is have a battle plan and then have a price that you are feel comfortable at paying for. For example, Amazon, I think, is at a steal at $160 a share. Amazon, based on their earnings, what I expect a price target for Amazon reporting earnings this week, I think it was Thursday, basically at 160, thank you very much, I'll take some Amazon. And it doesn't necessarily matter if we're basically going into a recession or if we're in a correction. I like the price point Amazon's at for what I think the revenue will be and where the revenue and numbers are. The build out phase of AI will continue. That's not going to stop just because of the jobs report. Now, the end game of AI, whether AI makes any money, will be told over the next 4 quarters potentially, or I think longer. I've heard some people say the fall, the basically Q4. I think it's going to take personally longer to show whether basically these companies start making money off of AI in the end game. But I do know the chips will still be made. I do know the GPUs will still be made. Those orders will still be placed because basically there's a lot of companies with a lot of cash, and I do think they're going to continue spending. Um, for me personally, we both have a few different ones. ASML. Think ASML, my price target for ASML is still above 1,000. It's still above 1,000. My price target for AVGO was still where it was previously, TSM. So some of these companies I don't see changing. I don't see basically there will still show revenue growth. And so when you see a certain price that you're comfortable with, then have a battle plan and go to battle. That's all I'm saying.
Yeah. And you just said a bunch of different things. One thing that you said was that you like the price of Amazon right now for their earnings. And what you're actually saying there is that you like the valuation. So you're saying that you like the PE ratio is what you're saying. Because price compared to earnings or revenue is the equivalent of what I just looked at, which is PE ratio. So valuation. So, and actually, I would encourage everyone to look at that before you just say, oh, SMCI was at a price of blah, blah, blah. And now it's at a price of blah, blah. I think that's good. No, no, no. Go look at their earnings. Go look at their forward P ratio. All you have to do is go to Yahoo Finance, click on analysis or statistics rather, and it'll show you the forward PE. So actually look at the valuation. That takes all the noise out of the room. That shows you clearly where it sits compared to how much money it's making. You might be looking at a company that isn't making any money at all. I wouldn't recommend investing in a company that's losing money, and we don't cover many of those. We don't cover many companies that lose money.
Don't, but well, absolutely. But what we have covered are companies with very high PE ratios. We'll cover Pega soon. Well, Pega still has a very high PE ratio for the earnings. So I like Pega as a company. ASML is at basically a steal right now. ASML is at a steal price for basically what I see the next 4 or 5 quarters, 2025. I'm just saying. So TSM, ASML, but
yeah. Yeah. So last thing before we wrap up, there are a lot of ways to play this. And Kai, you recently asked me, you were like, this is maybe a month ago. You were saying something like, I think we've learned a lot of the basic things. I think we mastered, like, what else is there to learn? And what I would say is playing a situation like this is kind of what there is left to learn. And there are a lot of ways to play it. Leverage ETFs is one way. And Kai, you've never really used leverage ETFs, but that's one thing. That's one thing to learn. Also, VIX, shorting or longing the VIX. So we had the VIX up 53% intraday on Friday, and then it dropped to down 30% intraday. So you could have shorted the VIX, meaning you could have bought an inverse VIX ETF. I'm actually not sure they have it. Rather just buy a put. You could have just bought a put on the VIX, and intraday you could have made leveraged beyond 20% leveraged. I mean, so there are amazing ways to play this. If you just want to be cautionary, you can buy TLT or some of the shorter ETFs. TLT is a 10-year, TLT I believe is a 20-year treasury ETF. That was up 2% on Friday. So when the entire market was down 3% intraday in the Nasdaq, TLT was up 1.5%. So not only are you going to make money as rates come down by holding the TLT Treasury ETF, also the price of the TLT Treasury ETF is going to go up as rates come down. So you're going to make your 2-3% whatever dividend, if you want to call it that, from that ETF while the price of the ETF goes up. So you've got some opportunity to do that. I mean, dividend ETFs, unfortunately, they hold stocks, so they might come down as stocks come down if we go more recessionary, but still they do pay in certain cases 8%. And guess what? As that ETF comes down, your dividend yield technically goes up. So you could be looking at a really good dividend ETF that pays 8% dividend right now, and that's an 11% dividend if we pull back 2 more percent. So what I would say is you have ways to play this. There are safe ways to do this. Look at if you think that things are too oversold, and I started doing this yesterday, and we'll see what you think of this, Kai. This is something you don't do that I would say is your next step. Kai, you need to jump into these leverage ETFs. Yesterday, you need to start looking at these leverage ETFs. They're not available on everything, but let me finish. Direxion ETFs. Everyone, go look at the entire listing of Direxion leveraged ETFs. If you think things are going down, guess what? You can take 2x or 3x leverage with minimal fees, and there is no expiration like options contracts. So if you think the TQQQ, if you think 3 times the NASDAQ is going down or up, buy that leverage ETF. You will make 3 times the money if you're right or wrong. So I'm starting to actually leg in to bullish leverage ETFs, and I'll continue. I started a tiny bit of position in 2-3x leverage ETFs. So that means if things start to recover, I will make 2 or 3 times the amount of money. And as things come down more, I will buy more leverage ETFs. No expiration, like options contracts. So there's no risk of me running out of time on that. I could wait years if I wanted to and pay a 1% yearly fee. But that's fine. If I'm making 30, 60, 90%, I don't care about a 1% annual fee. So that's the next step here, Kai. I would say look at some of these things that help you truly benefit from time periods like this. When people are flipping out, it's your best opportunity to make money. When people are flipping out, it is your best opportunity to make money. Not right now, but if you set yourself up right, you will benefit 3 months from now, 6 months from now, a year from now, 2 years from now. And to finally answer your question, The AI build out is real. When the internet came out, I remember 2004 to 2008, I barely ever used Google. ChatGPT came out. I used it every single day, all day. This is new. This is bigger than anything that's ever existed. AI is real and it's going to dominate our lives for the rest of our lives. You want to invest now, and now we have a pullback. So it's the best possible time.
Well, yeah. Well, thank you for saying that, James. I do want to make a couple comments. I also was going to say you didn't answer my question about the AI until just then, and I really appreciate you answering
yeah, we
that.
got to close
no, it was
out.
great.
So make it brief.
Well, no, hold on. I want to take up. So one of the things I'd like to do, please leave us some comments because we're going to leave some specifics. James has talked about leveraged ETFs as some specifics, and I'll talk about what I do. I want to hear your critiques for our listeners out there. Yes, no, was that a good move? Not a good move? So please leave us a comment. I will say my particular view on AI, though, is that the build out phase is occurring. That's a fact. It is unknown for me how much time to when basically it will become profitable. I don't know when that will occur. I do know that it's going to occur. Now, whether that's 10 years from now, 5 years from now, 6 months from now, 3 months from now, I would basically disagree with you on the timing of when that is going to occur because I do think change takes time. So one of the things that I've done over this last month, even over this last week, is become cash heavy. I think it was Warren Buffett who somebody would even ask, hey, oh my gosh, the market dropped. What do you think about the loss? You lost all this money. He goes, I didn't lose anything. He didn't lose anything. He basically didn't take a realized loss yet. And so, for example, I know you and I have talked a lot about, I've been to McDonald's. I had a very large position. I think 7% of my portfolio was in McDonald's. I took a pretty substantial loss in McDonald's, as an unrealized loss. Guess what? I didn't lose anything. And McDonald's went past my cost basis. Basically, I went to battle and kept to my plan, and I didn't earn that much, but about 7% APY on my trade, right? That beat money market fund at 5%. So you didn't lose anything unless you panic potentially and sell. And I'm not saying don't sell part of your position. I think it's okay to trim and have a plan and stick to your battle plan. So one of the things I did is move some of the money. You can go through the sectors, you can look at ETFs, you can leverage them, but you can go to see where the money's flowing. One of the trades that I have put on is gone long on energy. NEE is a company I have a fairly decent position in. And one of the companies I actually put some money in, you make fun of me, but it's Costco. I actually bought some Costco on Friday, for which I thought was a pretty fair evaluation. And some of these, basically, sometimes tech or some of the tech sector may move into some of these other sectors. Now, it was very hard to find a sector that was not just bludgeoned on Friday. But one of the trades I did was Costco. Let me know what you think of that. And then basically I took some profits. I'm still in a company called Chubb, which is an insurance company. I have a pretty large position there. I do have a small position in Pega, and it didn't, I had taken profits. Some of the profits that I had taken was Meta. So basically I trimmed my Meta position. I took some realized gain, but I'm very heavy in realized gain for the year. So I'm okay with a little loss, and I'm basically going to wait. And to use Warren Buffett's term, I didn't lose any money. So, yeah, what do you think about that?
So
and then let's go.
Really, really quick, 3 things on that. So first of all, you mentioned oil and energy. Even if Israel was to wipe Iran and Yemen off the face of the earth, that's only 4.3% of global oil supply. So yeah, so basically, you don't need to worry about a massive spike in oil. There's so much supply of oil, and they're a rather small percent of that supply. So don't worry too much about that conflict. But I have heard that oil is setting up well. We may see at least a stabilization and maybe a slight increase in oil and energy. Second thing you said was consumer stocks, retail stocks like Costco. So first of all, if we are going into recession, and the next 6 weeks will really tell, you have to be careful about stocks like that. But it depends on how much they've already pulled back. I've recently been a buyer of Toyota, Lulu, and Tesla, and I sold my Tesla because I saw a really, really, really bad report from an expert about how Waymo is like 900 times better and more accurate than Tesla self-driving. So I think a lot of people are betting on robotaxi. So I've sold that. But Lulu had just pulled back so much. So it depends. If they've already pulled back a whole lot, including Toyota, you're a little bit safer going in, even if we're having a drawdown. But in general, retail, you have to be careful if we're going to recession. They're gonna perform poorly. And then the last thing you said, what was the last thing you said? Is there anything else for me to respond to?
The
think so.
sector is looking at Costco.
Oh yeah. So I was going to
Yeah,
say, as far as that's
energy.
concerned, just if you have conviction, guess what? Direxion has probably bearish and bullish leverage ETFs for retail. So if you really have conviction that retail is going to do well or do poorly over the next months, take 2 or 3x leverage. I mean, moments like this are your time to actually take on more leverage. When things move drastically in one direction, it's your opportunity to predict a continuance of that movement or a reversion of that movement and make a little bit more money.
Yeah. Well, thanks for listening. Those particular things James and I have done essentially during the week or prior to this pullback and correction. Critique us on those. Please leave us your comments. We are going to be talking about a company, Pega, soon, and we'll talk about other companies. Pega, essentially one with a very high PE versus some of the others that James highlighted. So, yeah, thanks,
Awesome.
James.
Yeah. Thanks for tuning in to our show, our emergency show about running for the hills and pooping your pants. Please give us a like or comment, and we'll be back in the next episode to cover Pega Systems. You can find all our holdings and trades at investingintel.ai. Thanks so much, Kai.
Thanks, James.